Have you ever wondered what would happen to your assets if something happened to you? Would they go to the people you love, or would they end up causing family disputes and legal headaches? Estate planning isn't just for the wealthy or the elderly, it's something every Singaporean adult should be thinking about. Because let's be honest, life is unpredictable, and without a proper plan, your hard earned money might not end up to where you want it to. So, if you ever thought that estate planning is too complicated or not for me, let's break that mindset today. Hi, I'm Fur from Dollar Bureau, a personal finance platform that talks about insurance, investments, and financial planning. Today, we're talking about estate planning, what it is, why it matters, and how to do it right. So, let's start with the basics. What exactly is estate planning? Estate planning is basically making sure that your assets, like your house, savings, investments, and even your digital accounts, go to the right people after you're gone. It's also about appointing trusted individuals to make decisions for you if you become mentally incapacitated. Think of it as leaving a roadmap for your loved ones so they know exactly what to do and when. But why is estate planning so important in Singapore? Well, there are five main reasons. Number one, you want to avoid family disputes. Without clear instructions, your family might argue over your assets. And trust me, this happens more often than you think. A simple will can prevent misunderstandings and keep relationships intact. Number two, to minimize taxes. While Singapore abolished estate duty in 2008, certain inherited assets like property may still attract ongoing taxes, such as property tax or tax on rental income. Proper estate planning, such as using trusts, can help you ensure your wealth is transferred smoothly, protected, and in line with your wishes. Number three is to protect minor children. So, if you have young kids, you can name guardians in your will. This ensures someone you trust will take care of them instead of leaving it to chance. Number four is to manage incapacity. So, if you become mentally incapacitated, a lasting power of attorney lets someone you trust handle your affairs. And of course, number five is to ensure smooth estate distribution. Without a will, your estate is divided accordingly to Singapore's intestacy laws, which might not match your wishes. Planning avoids probate delays and ensures everything you want goes to where you want it to. Okay, so we've established that estate planning is clearly important, but what tools can you use to actually put your plan into action? Number one, you can use wills and testamentary trusts. A will outlines how your assets should be distributed and lets you name guardians for your children. A testamentary trust, which is created through your will, manages how your assets are given out, like setting conditions for when your kids can receive money. Number two are CPF nominations. Your CPF savings don't get distributed through your will. They're handled separately under the CPF rules. And if you don't make a nomination, your CPF money will go to the Public Trustee's Office, which will distribute it according to the intestacy laws, which are just the default rules if there are no wills. That process can take months or even years and comes with administrative fees and might not reflect your actual wishes, especially if you want to provide for a specific dependent like your parents, your partner, or your children. So it's important to submit your CPF nomination and review it regularly, especially after major life events like marriage, divorce, or having children. Number three are life insurance nominations. Just like CPF, your proceeds don't follow your will. You can do a nomination to ensure payouts go directly to your chosen beneficiaries quickly and securely. Number four is the lasting power of attorney, which lets you appoint someone to manage your personal or financial matters if you lose mental capacity. It's an important safeguard, especially as you get older. Number five is the Advanced Medical Directive, which lets doctors know that you don't want extraordinary life-sustaining treatment if you are terminally ill and you're unable to decide for yourself. It's a sensitive topic, but it ensures your wishes are respected. Number six are inter vivos trusts, which are living trusts created while you are still alive. They help manage and protect your assets, avoid probate, and can even come with tax benefits. Number seven is the manner of holding of your property. So, how you hold your property matters. If you have a joint tenancy, then the property goes automatically to the surviving owner. If it's a tenancy in common, your share becomes part of your estate, which means that it can be distributed through your will. But what if you're Muslim? The rules around estate distribution works a little differently, so let's go over that next. If you are a Muslim, your estate is governed by the Administration of Muslim Law Act. This means your assets will be distributed according to Sharia law, not the Interstate Succession Act. There are also tools like the Wasiat and Hibah you can explore for Islamic estate planning. I'll cover more on this in another video, so do be sure to subscribe and hit the notification bell icon. So, now you might be thinking, when should I actually start estate planning? Well, the short answer is the sooner the better. But here's a more practical breakdown, right? So as a young adult, even if you don't have lots of assets, it's a good time to create a simple will, set up your life insurance and CPF nominations, and understand how your assets will be distributed if you pass on. If you are a married couple, marriage brings in new responsibilities and a need for a more comprehensive estate planning. So if you own property or other assets jointly, it's important to discuss and plan how these should be managed and distributed. Secondly, ensure that all beneficiary designations on your insurance and CPF nominations, and of course your investment accounts, are updated to include your spouse. You should also consider setting up a lasting power of attorney to allow your spouse or someone you trust to make decisions on your behalf if you become incapacitated. Next, when you become a parent, your estate planning needs to become more complex and crucial. One of the most important steps is to designate guardians for your minor children. This ensures that they are cared for by someone you trust if you are no longer around. Consider setting up a trust so that you can ensure that your children's financial needs are met, such as education and living expenses, until they reach adulthood. A comprehensive will is also important, so make sure to update your will to include your children and specify how your assets should be distributed amongst your family members. Next, if you are a retiree, retirement is a critical time to review and finalize your estate planning. Clearly outline how you want your assets to be distributed amongst your heirs. This can help avoid potential disputes and ensure your wishes are carried out. You should consider setting up the Advanced Medical Directive to outline your wishes for medical care if you become terminally ill. And of course, lastly, to regularly review and update your estate planning documents to reflect any changes in your financial situation, family dynamics, or health. For instance, when you get married, any wills you had are revoked. And if you are divorced, the wills are not revoked. So regular reviews ensures that things are still valid so that it goes to the right beneficiaries. So, depending on where you are in life, your estate planning needs will evolve. But regardless of your stage, there's a general step-by-step process you can follow. So step 1, basically list all your assets and liabilities by creating a complete inventory of what you own and what you owe. Include things like your bank accounts, your properties, your loans and debts, your insurance policies, your CPF savings, your investment accounts across different multiple brokerages. List all of them down. And don't forget overseas assets too, right? So they might follow different inheritance laws and your family might not know you even have them. Step 2 is to identify your key contacts. So list down the people who help manage your financial and medical life. So these are people like your lawyer, your financial advisor, your insurance agent, even doctors as well. This makes it easier for your family to know who to call if something happens. Step 3 is to understand your accounts and beneficiaries. Not all assets are covered by your will. So check who the beneficiaries are for your insurance policies, CPF, and joint accounts. Check whether your loved ones will have access or will need probate to these accounts, and if any accounts are held jointly, which means it might even bypass your will entirely. Step 4 is to track your digital assets. So make a list of important digital accounts, such as your online banking, your emails, your crypto wallets, your cloud storage, or your subscription services. Also note down the login details, recovery methods, or where to find them securely. Maybe if you're using a password manager or a sealed document, this is something that you can include in your estate planning. Without this, your digital life might be locked away forever. Step 5 is to keep your contact details up to date. So ensure your name, address, and contact info are correct with institutions such as banks, insurers, and even the CPF boards. This avoids delays or complications when it's time to process claims or even distribute assets. Step 6 is to stay on top of your liabilities. So keep a running list of outstanding debts, right? Include your home loans or your mortgage, your credit cards, your personal loans, your tuition fees, or education loans for your children. Doing so helps your families understand what needs to be repaid and whether you have insurance coverage to handle it. If you don't have insurance to cover your debts, you should definitely consider it. It's more for your family than yourself. And step 7 is to start early and review regularly. So don't wait for a health scare or a milestone birthday. Start your estate planning while you are still in control and update it when life changes, like after a marriage, divorce, a new child, property purchases, or a change in assets. Now, you might be wondering, what if I skip all of this? What's the worst that can happen if I don't have an estate plan? Well, if you die without a will, your estate goes through the Interstate Succession Act, which just means that if you have a spouse and kids, they split your estate accordingly. And if you have no kids, your spouse and parents split it. If you're single, then your parents or siblings inherit them. But here's the problem: this might not actually reflect what you want. It can also delay your distribution of assets, increase legal costs, trigger family disputes, leave vulnerable dependents without enough support, and result in unintended beneficiaries. So the bottom line is, not having a plan can create way more problems than you think. So now that you understand why estate planning matters, what tools you can use, and what to expect at every life stage, let's wrap things up. Estate planning might feel overwhelming, but it's really about a peace of mind. We've talked about wills, CPF nominations, LPAs, trusts, and more. The tools are there. The earlier you start, the better and protected your family will be. And if you're not sure where to start, you don't have to figure it out alone. We work with experienced licensed financial advisors who can help you build a customized estate plan that fits your goals. You'll find the link to talk to one of them in the description below. If you found this video helpful, hit that like button, share it with someone you care about, and subscribe for more practical financial tips. Thanks for watching, and I'll see you in the next video.